As we have seen in the previous videos, the company's leverage effect return on equity, relative to asset value change. Well, what about the leverage of the investor himself? Let's assume that the investor uses 50% debt to invest in the company with 50% debt financing. At the end of the day, what the investor only cares about the most is how his own equity grows after servicing his own debt. With 50% debt, when the company's asset value increases by 25%, company's equity, as well as the investor's asset increase by 50%. As a result, the investor's equity grew by 100%. Only 25% increase of the company asset results in 100% increase in the investor's equity. The investor's equity is 4 times more sensitive than the company's assets. Why is that? The company's equity is 2 times more sensitive than the company's assets. Likewise, the investor's equity is 2 times more sensitive than the investor's assets. Because the company's equity and the investor's assets are equal, we multiply these two, then we get the multiple leverage of 4 times. 2 times 2 equals 4. It is important to understand that the leverage effect multiplies. At the end of the day, you would only care about how sensitive your equity fluctuates, relative to the underlying assets of your investment. There are an unlimited number of leverage combinations that result in the investor's equity being 4 times more sensitive than the company's assets. It might be 4 times 1 equals 4. Or 1 times 4 equals 4. It doesn't matter how the company or the investor himself is leveraged in each cases. All that matters is combined leverage, in this case is 4 times. In other words, it doesn't matter what the combination is. The investor's equity is 4 times more sensitive than the company's assets in all 3 cases, and that's all that matters to the investor's point of view.